Hello and welcome to Ticker Tapes. Today we're taking a look at the world of high growth stocks. Elon Musk is back in the news if indeed he was ever out of it. This time the world's richest man has backtracked on his recent email to executives about slashing the Tesla workforce by 10% because he had a super bad feeling about the economy. In a tweet at the weekend, Musk now admits that Tesla's headcount will increase over the next 12 months. However, he also commented that the recruitment of salaried staff would be flat, implying that the company will be hiring more agency or part-time staff going forward. Tesla stock traded down by 9.22% in Friday's session, wiping out all of the gains the stock had made earlier in the week. Brokers Cowen cut their $790 Tesla price target to $700, citing challenges at the firm's factory in Shanghai. The plant is now thought to be running dual shifts and be close to full production. However, recent lockdowns are believed to have caused a $50,000 vehicle shortfall, which could prove challenging for Tesla's cash flow and working capital commitments in Q2. And that in turn could mean that Tesla won't meet its goal of raising global production volumes by 50% in 2022 as a whole. The number of NASDAQ 100 stocks trading above their 5-day moving average plummeted last week, falling from a near-term high of just over 96% on May 27th to a reading of 36.27% at the close on Friday, the 3rd of June. That fall came despite employment data that showed the economy was still adding jobs at a faster rate than Wall Street analysts had anticipated, with 390,000 new jobs being created in May. That means that employment is now just 822,000 jobs below its pre-pandemic level. However, there are signs that startups and growth companies may now find it harder to access additional capital, with venture capitalists in Australia declining to pump more money into 2 local grocery on-demand startups. Whilst buy now, pay later group Klarna has recently culled 10% of its headcount, despite the business still supposedly being in a growth phase. Corporate data specialists Crunchbase.com has compiled a list of 58 growth companies that have laid off staff during 2022, the majority of which are based in the USA. That suggests that purse strings are being tightened as U.S. interest rates start to rise. In its widely read Flow Show report this week, Bank of America highlights the fact that the 12-year-long technology and growth boom could be over as central bankers withdraw $3 trillion of liquidity from the market over the next 18 months. However, the bank's private clients are still invested in the technology sector, though their allocation to growth stocks has been reducing, with money moving to defensive sectors such as healthcare and real estate investment trusts, pushing growth and technology into third place when measured by the flow of funds into these sectors over the last month. That's not so surprising given that RPG, the Invesco S&P 500 Pure Growth ETF, is down by 22.13% over the year to date.